Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
On security alert, the FBI investigates a potential link to terrorist groups after a deadly attack in New Orleans. New Year's rebound. Markets kick off the year with tech leading futures higher after a year-end slump. And Nippon Steel ramps up its effort to win approval for its takeover of U.S. Steel. Good morning, Manus. Happy New Year.
Danny, good morning. Happy New Year. Day one, and we're risk on for now. The question is, will that endure? We're shaking off the shackles of the longest losing streak to the end of the year since 1966. I think the UK won the World Cup that year. The Russell crashed by 8% in the month of December, the worst month since 2022. We're bounding higher by 0.5% this morning, but it is tech that leads the charge. Roll it over, have a look at the bond market, because, of course, bonds were the tortured souls of returns of 2024. They delivered a loss of 0.6% for 2024. They gave a huge amount back in December. It's up in yields for 4 years in a row. That's the first time we've seen that. Deutsche Bank talking about that this morning. Term premium is up. Is that enough to bring you in at 4.54% in the bond markets?
Meanwhile, we got a couple equities that we're keeping our eye on your first trading day of 2025. Tesla, one of them, it's going to be delivering its fourth quarter sales later this week. Shares are moving higher in the pre-market, more than 1%. BYD sales also came. Those hit a new record.
MicroStrategy surging as Bitcoin kicks off the new year after a record-breaking 2024. And President-elect Trump prepares to take office.
Meanwhile, Alphabet getting a downgrade this morning to perform from outperform at JMP Securities. Analysts saying the possible impact of antitrust penalties on Google revenue streams. Those shares still moving higher pre-market, Manus.
In just a few moments, we'll set your agenda for the start of 2025. Where to put your money. Dan Morris, BNP Paribas Asset Management, joins Danny and I. And then Sonia Meskin of UBS will give us the economic roadmap. Danny, good morning. We're counting down to the inauguration of Donald Trump, and in that first 100 days, it's going to define, in many ways, the angst that we've talked about a great deal into the close of 2024.
But how reactive will markets be? Because so far to any tariff news, be it the Panama Canal, be it Canada, be it anything, markets haven't been reactive. Maybe we're more humble this year after literally getting the past 5 years wrong, going into it, be it COVID, be it inflation, be it a lack of recession. We keep getting these calls wrong.
Look, 100%. I think the question of the sequencing, when does the tax bill come through? So a lot of the euphoria, 24% up in the S&P 500. How much is that predicated on the Fed? How much of that is predicated on the tax policy that's going to be enacted as he comes to power?
Well, we almost had a government shutdown to end the year. Let us not forget the quarrels that we had in Congress. Congress starts very soon. The new double chambers of both Republicans coming in. Already, though, it's clear that there's a divide, even though they have a majority. How easy will it really be to pass some of Trump's priorities?
Well, there's 38 rebels out there. They showed their teeth just before Christmas. Will they do that again? Let's put this all together. We've got Dan Morris kicking off 2025 with us this morning from BNP Paribas. And this is what he says about markets. They should eventually have all priced in, all the good news for U.S. equity markets and bad news for Europe and China. At which point the US may disappoint and the other markets surprise. We are likely not at that point yet. Dan, good morning. Good to see you. We're kicking off with a brave bid to these markets this morning. So for you, as you start 2025, do we still remain in a period of US divergence and exceptionalism? That remains intact for now. Will it endure for the whole of 2025?
Well, I think that's the important distinction. Danny pointed out how, in general, we've all been wrong over the last 5 years in terms of predictions, and I don't know that's necessarily what we're here to do. I think as an investor, you're trying to look at this point in time, how do you want to be allocated? What's the optimal allocation? And we do think that is still an overweight to U.S. equities. That said, you're constantly evaluating that position, looking at the different scenarios that you had to have ahead of you, and seeing if you're moving into another scenario where maybe that's not the best allocation.
Just looking at where returns for this equity market, total returns came from over the past year. About 1% came from dividends, about 10% came from higher stock valuations, about 13, the final 13, came from rising expectations of earnings. Dan, in those buckets, where can we juice further returns from? What looks like it can keep growing?
Well, I think we want to look primarily at the earnings expectations. And two things to keep in mind. I mean, we appreciate, especially at the beginning of the year, you have analysts that tend to be fairly optimistic and you have pretty robust year-on-year earnings growth forecasts. And you can argue that once the year starts, the EPS estimates tend to fall. And that's fine as far as the equity markets are concerned. You want to focus on what's going to be the absolute return. So even if we don't quite get, say, 20% earnings growth for NASDAQ, the way analysts might suggest, if it's only 15, then clearly, well, not clearly, likely markets will do well. So we want to keep those two things in mind. Yes, there may be negative revisions to that outlook if things aren't quite as positive, but if it's positive earnings growth, that's really going to be what drives the market.
Well, Dan, that's the equity side of the bucket. Let's talk about the bond side of the bucket. I want to come back in another life as a high-yield treasury because, I mean, that's where there was real delivery, 8% overall for 2024. And treasuries themselves lost just under 0.6%. When you look at the bond market, you know, the low bar that I see in front of me for performance in treasuries is there. How do you look at this bond market going into 2025?
Well, frankly, we're still in the range that we've been in for quite a while, anywhere from 5 at the top, and we were at 5% in October 2023, if I'm not wrong, to low 4s for this year. So we're still in that range, and I think that reflects, honestly, what is still a significant amount of uncertainty about where things could go from here, and much more impactful, honestly, for fixed income than necessarily for equities. So on one hand, if you do have much more growth, higher inflation, that would argue for higher treasury yields. At the same time, if you have policies that turn out to be negative for growth, you could see yields fall. Now, clearly that's not particularly helpful to say yields could go up or yields could go down, but I think that does explain why you've had relatively little, honestly, volatility in fixed income because of that uncertainty.
Dan, let's put these two things together. For asset allocation in 2025, in a moment where equities look to be maybe the strong place, but valuations are unusually high, when we could have the volatility that you're talking about in this bond market, but real yields are basically as high as they've been in the past 15 years. What does the balance look like between risk-free assets and risky assets in 2025?
I mean, we are marginally overweight equities, so we think that's a better place to be, and to U.S. equities. So, you know, again, constantly evaluating that allocation, but from our point of view today, that seems to be the best way to allocate.
We've just had a brief chat, Danny and myself, about the 38 holdouts in the continuing resolution just before Christmas. How important is it for exceptionalism, U.S. asset outperformance, that we do understand what the tax roadmap is a little bit sooner than the back end of this year? Because that's the deliberation whether they go for energy and immigration and defense in one bill and tax in the second bill. How important is the choreography to you, Dan?
Well, it certainly would be significant. At the same time, we want to remember that generally politics don't matter that much to the economy and the markets. Really, it is what the Fed does that's going to be more impactful. That said, when you do have single-party control of government, that's when it can matter a lot more. So the details are what's going to count. We, like everyone else, are waiting to see at least a bit more what those details are going to be. We're waiting for the inauguration, and then the markets will have to reassess what they think the path forward is after that.
Then, Dan, is this year different? Is this a different year in which the politics does matter and maybe what the Fed matters less?
I think it'll be like it was, say, the first part of the Obama administration when you had Democratic control, first Trump administration when you had Republican control. Those were exceptional years insofar as on a relative basis, you're right, the politics did matter more. I think that will likely be the case this year, but at the same time, we certainly don't want to forget what the Fed is doing.
Do you think, Dan, that there'll be moments of high volatility in equity markets? We've used this phrase before Christmas of exuberant corrections. Is that part of the landscape of this year? Because the politics are going to cause air pockets. We've seen them before. We have precedent.
Well, if anything, the low volatility you had both in the VIX and in the MOVE index a couple of weeks ago was more the surprising scenario where none of us really thought the outlook was going to be so smooth or so certain, but you saw MOVE and VIX quite low levels. They've come back up, which is probably healthy. I think we need to appreciate there are going to be some shocks. It's going to be the challenge then to take advantage of those, if you will, to find the opportunity in the volatility, which I think is almost certain to come given the politics, given the geopolitics, given the uncertainties about the economic outlook. It's part of how we try to invest, and that's going to be certainly impactful both for equities and fixed income markets.
Dan, we're going to have to leave it there. So great to kick off the new year with you. Thanks for joining us. Dan Morris of BNP Paribas Asset Management. Let's get you some other top stories now that are trending on the terminal. A person familiar tells us that leaders from the U.S. Dock Workers Union and employers are set to resume contract talks on Jan 7th as a threat of a strike looms. If a deal is not reached, a strike could occur when the temporary extension expires on January 15th, disrupting the country's container volumes.
To the UK, house prices there are climbing within touching distance of record highs at the end of 2024, suggesting the resilient property market gathered more momentum. It was the fourth consecutive monthly increase, and it chimes with other data showing solid buyer demand despite affordability challenges. House prices are expected to climb 4% in 2025.
Citi and Bank of America are becoming the latest lenders to leave the Net Zero Banking Alliance. That's a global climate group. Already, Goldman Sachs and Wells Fargo have left. The exits come as financial institutions are getting pressure from Republicans to distance themselves from groups supporting carbon emission reductions.
Coming up, Nippon Steel makes a last-ditch effort to buy U.S. steel. More on the details of the offer. That's next on Bloomberg.
It's your Bloomberg Brief on the first trading day of 2025. Danny Berger alongside Manus Cranny in New York. President Biden is entering his final days of his term, and with that, Nippon Steel has decided to act. The Washington Post reporting that the Japanese company has made a fresh offer in its bid to take over U.S. Steel. You can see there U.S. Steel jumping on the news, almost 10.5%. On that, the most in a year. For more on that, let's bring in Bloomberg senior editor for U.S. Economy and Government, Derek Wallbank. Derek, what exactly is this new offer on the table?
Well, the new offer aims to deal straight with a CFIUS objection. Remember, CFIUS is that group in the U.S. government that reviews foreign transactions for national security things, and it advanced this sort of unique economic security argument. And so the Nippon Steel deal offer here is actually pretty straightforward. It basically says it would give the U.S. government a veto over any potential decreases in American steel production, U.S. Steel Corp production capacity, right, as a result of this transaction. And so it's a very straightforward attempt to deal with the CFIUS objections at face value. Now, there's sort of two ways that you can look at this. One of them is to say this is a Hail Mary attempting to deal with this on its face, but this may not have been about the face issues. This may be, more things going on, and this is sort of destined to go anyway. President Joe Biden has 15 days from the CFIUS review coming in to give a verdict on this. There's reports that he is disinclined to acquiesce. So that's one way. But the other way is to say, look, maybe there's some behind-the-scenes 3D chess going on here, and maybe this is a way that every party can save a certain amount of face and get the deal done. And certainly the market reaction a little bit split the difference, but did hew a little bit towards part two without fully pricing in part one.
Well, it's interesting, Derek, good morning to you, the way in which Nippon have attempted to counterbalance the argument. They've basically said, look, without this transaction, given the limited resources of U.S. Steel, it will revert to a pre-transaction strategy of deprioritizing existing union-represented facilities. So this is, carrot and verbal stick, isn't it?
Yeah, it really is, Menace. And again, sort of to the point that I was making here, I'll just sort of read from the pricing here, right? The shares are still trading. We're still trading at more than $20 less per share than the offer. So there's still a wide amount of market skepticism sort of priced in, right? But you are seeing a lot of these sort of, I don't want to say quite Hail Mary, but sort of last minute maneuvers. And sometimes you say the good bits and sometimes you say the scary bits. And overall, you hope that something comes out of it. Now, Donald Trump has said that he's not a fan of this deal, but it's not going to be his call necessarily because this does come due during Biden's presidency. And look, we've seen this White House now in the last couple of weeks become a little bit less predictable, and so maybe there are some last-minute options that are available to Nippon Steel as they go forward with this. That's certainly what they're hoping by putting forward an offer like this to try and deal, as I say, with the face value objections that have been raised in the review process.
Derek, is there not some risk, though, in an agreement that takes this form, that gives the government a veto power? Because, as you say, Trump will come in, and he is someone who has publicly said many times that he doesn't think this deal should go through.
Well, yes, Danny, and that's right. I mean, administrations change, don't they? And the times change with the administrations. Now, I have heard, and this is sort of to pull back a little bit, but I think it gets at a larger issue that you bring up. I have talked to a lot of diplomats in this part of the world, sitting in Singapore right now, who have said that they're trying to, amid the wild gyrations between administration and administration in the U.S., trying to find ways for their countries to pursue sort of administrative agnostic relations with the United States and sort of insulate there. So there is some hope that if some of these deals, whatever they may be, can get sort of nailed down and written down so that there are key triggers, then maybe you actually do get some of that administrative agnosticism. But you're quite right to highlight the idea that these administrations do change, and the one from Biden to Trump, just as from Trump to Biden and as from Obama to Trump before, you're going to see some very wild policy gyrations where certain things that were off the table for Biden are on with gas for Trump, and certain things that were on with gas for Biden are dead in the water under Trump. And that's going to be a key geopolitical risk thing we're going to be closely tracking. But I think all market participants are going to be tracking this year. This is going to be a key market theme throughout 2025 for sure.
Okay, Derek, well, let's see what comes through. The clock is ticking down, as you said, still trading at a discount to the original offer. Derek Wallbank there on the very latest on Nippon Steel's offer for U.S. Steel. Markets kicking off 2025 in the green, Danny, on S&P 500 up 0.5%. But that dollar had a blinding year last year, up 8%, the best year since 2015, and we're flat at the moment.
Yeah, and this Treasury market, again, it had somewhat of a bid to end the year. Continues. We are lower on your yields by nearly 3 basis points, 4.54%, Manus.
Coming up, two deadly events over the holiday set off an FBI investigation into a possible link to terrorist groups. We give you the context on Bloomberg Brief. It is Bloomberg Brief. I'm Manus Cranny alongside Danny Berger here in New York. Let's get you up to speed with your front pages on day one of trading in 2025.
Yep.
We have the Journal kicking off with Russia has halted natural gas flows to Europe via Ukraine after Kyiv's refusal to extend a pipeline deal. Ukraine said it wouldn't extend the deal because it was providing revenues that helped Moscow conduct its war in Ukraine. Now, the end of the deal was long expected and will have limited impact on Europe's gas supplies.
Next up, the Washington Post has this, that Chinese hackers breached the Treasury Department's sanction office. That's according to officials there. The targeting reflects Beijing's determination to acquire intelligence. There have been a lot of Chinese-linked hacks as of late. The full impact of that breach, which was disclosed by the Treasury in a letter to Congress on Monday, that Manus is still being assessed.
And on Bloomberg, the U.S. security is back in the spotlight after the deadly attack in New Orleans and an explosion of a Tesla Cybertruck outside President-elect Trump's hotel in Las Vegas. That was on New Year's Day. President Biden spoke about the two incidents at a press conference.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
Now, here's what we know at this moment. In New Orleans, at least 15 people were killed. Dozens were injured. The suspect was killed at the scene, a U.S. Army vet, a U.S.-born citizen who was also flying an Islamic State flag on his truck. Posts on social media, Manus, also indicated that he was inspired by ISIS. Just to put a bow on this, law enforcement and intelligence officials have been warning for months that conflicts in the Middle East could mean that there are lone wolf attacks inspired by them, inspired by extremists, that could happen during the New Year's and Christmas celebrations.
And the FBI are investigating this as an act of terrorism in New Orleans. But if we pivot to what actually happened in Las Vegas, it was a separate incident. A Tesla Cybertruck exploded in Las Vegas. This was in front of the Trump Hotel. Now, Elon Musk has said online that he suggests it could be linked. This is from Musk himself, not the officials, that it could be linked to the attack in New Orleans. Provides no evidence for that. The FBI, as I say, are investigating both, and we should say that in that incident, the driver has been killed and 7 others are injured. Musk has said it's a very large fireworks and a bomb carried out in a rented Cybertruck. And we know so far both these cars have been rented from one company.
Right. It's called Turo. And that's specifically what Musk pointed to say that they were linked. Again, officials at this moment do not believe there is any link, but they are investigating them at the time. You heard comments from Biden there. Trump posting this on Truth Social, saying our hearts are with all of the innocent victims and their loved ones, including the brave officers of the New Orleans Police Department. The Trump administration will fully support the city of New Orleans as they investigate and recover from this act of pure evil.
And it is that. He describes it as an act of pure evil. And the explosion in Las Vegas, according to him, according to law enforcement, was intentional. We'll keep you abreast as we get more news flow in terms of the incident and what is going on with that.
Yeah, and coming up, we also are going to talk about the policy impact on markets. We'll catch up with Sonia Meskin of UBS on your brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Kriani. Let's set your agenda.
On security alert, the FBI investigates a potential link to terrorist groups after a deadly attack in New Orleans and a Tesla explosion. New Year's rebound, markets kick off the year with tech leading futures higher after a year-end slump. Nippon Steel ramps up its efforts to win the approval for its takeover of U.S. Steel. Good morning and Happy New Year, Danny. Welcome 2025.
And welcome to the first trading day of 2025. And you'd hope that this is the pace that we set for the year. The NASDAQ leading the gains, as you mentioned, Manus, up more than 0.7% after a clear risk-off move since Christmas. The S&P falling for 4 consecutive sessions. That's the first time since September. Maybe just locking in profits after a 25% plus total return for the S&P. Your 10-year yield, that is also seeing a bid, yields falling this morning for the bond market. It is the 4th consecutive year, though, that you've had Treasury yields move higher, the first time since the 1980s. Again, a bid here. How long does it last? What does policy look like? Manus, there are so many questions, and I think anyone who enters this year with certainty maybe needs a hubris check, because we have gotten this wrong literally for the past 5 years.
Yeah, absolutely. But there's brave trading ranges in between. 23% up on that S&P 500 last year. Bonds lost 0.6%. Dan Morris, I mean, fully hedged or what? 4% on the downside, 5% on the upside. And then you read the front of the FT this morning. Maganomics will deliver stagflation. And I think that's an interesting survey of the world, of the pool, of that echelon of society that lives in the finance bubble.
Well, it's an uncomfortable place to be. And I think Daniel Morris of BNP really underscored this idea that Treasury markets are going to be really volatile. So the sure thing is U.S. equities. But how sure of a thing are they when valuations are incredibly rich, when we're still being driven by tech? You say U.S. equities do the best, but again, how comfortable can you feel sitting in that risk asset?
It's whether that exceptionalism endures and whether you actually do get, you could actually get a bit of a shock from Europe, a bit of a shock from China in terms of stimulus. I love what Peter Cheer said at Academy. Messy is manageable. Chaos is not. Negative on rates, negative on equities, and therefore on credit for the start of the year. I like that. Messy is manageable. I like that most mornings at around 2:20 when the alarm goes off.
Sometimes we are quite messy at that time, but manageable. Will the new
Absolutely, every day.
Will 2025 be the same? We are just a couple weeks from a new administration stepping in to the White House. Sonia Meskin of UBS looks ahead to the market impact, writing this. We expect new administration policy risks impacting 2026 more than 2025 in real terms, but headline risk remains high in 2025. And we can see economic agents altering their behavior based on policy concerns. Sonia, I'm pleased to say, joins us now. Sonia, great to see you. Thanks for spending your first day of the new year with us. First day of the trading day, I should say. It is January 2nd. But I love this idea because at the moment, we don't get to see what's in the policy box really until this year, and we don't see the effect of it until 2026. So just taking a peek in and having that imagination run wild, what can it actually do? What impact can it actually have to this economy?
Well, for 2025 specifically, what we're looking at is any kind of change, as you guys just mentioned, from various economic agents. Are businesses altering their mix of imports, for example, right? Are consumers altering what they're potentially going to buy as a result of anticipating tax changes or as a result of anticipating, higher prices, for example, from tariffs, right? We're not seeing any of that yet. We would first expect this to see on the business side, but it's not showing up on the business side as far as we can see yet. People are talking about it, but they're not yet putting their money where their mouths are.
One thing we saw just before we went home that sort of slid under the radar was the Purchasing Managers Index in Chicago dipped. The leading economic indicators also turned negative. There are, I would say, cracks, not fissures, and not implosions. So how do you look at economy 2025? Does the US still diverge, strongly from the rest of the world, given the status quo, even just at status quo?
Well, we have a lot of moving parts here, right? And so even if the U.S. does continue to slow, the divergence could still persist because there are many difficulties also facing other major economies, namely China and Europe, right? And the housing market in China, for example, and the consumer in China continue to be relatively weak. Similarly, the whole transformation to electric cars in China is impacting the car industry. In Germany, for example, we still have high energy prices hurting Europe. So the U.S. is immune to some extent from a lot of the impact of those policies. Not fully, but to some extent. And we also have a very strong consumer. We have a huge wealth buildup.
It is interesting because the frame has been U.S. exceptionalism. Everything you're saying makes complete sense in that light, but driven by policy, driven in tax changes. I was looking at some of the sentiment surveys just to end the week. There's one from the ISM that their forecast is that the increase in manufacturing capex will be less in 2025. The National Association of Manufacturers says that their expectation is a 1.6% growth over the next 12 months of capex, which is kind of weak if you're expecting all these tax cuts. And a lot of people pointing to just the unknowingness of tariffs. If we don't know what's going to happen, how much in that self is a reason to pull back, is a reason for the economy to slow down rather than the expectation of tax cuts for corporations?
Absolutely, and that's part of the risk, I think, heading out of 2024 into 2025 that we've highlighted multiple times, is that, yes, deregulation can be helpful to the markets, but the uncertainty from tariffs, and there's going to be a lot of headlines coming out on this. There's going to be probably a lot of negotiation in the background going on. The uncertainty itself impacts business investment.
And this is the front page of the FT this morning, Maganomics. They've done a survey, and it is that short-term juice, let's say, from the tax, but the downside is for global growth, and that delivers ultimately stagflation. Is stagflation a 2020, to your point, Danny, is stagflation a 2026 issue, not a 2025 issue?
Well, even stagflation alone is a term that we need to unpack a little bit, I would say, because do we see from the tariffs, if the tariffs are in fact put in place, and there is broader tariffs and there is potentially retaliation from trading partners, does this all lead to a one-off rise in prices or in increasing in prices over periods of time, which really would be stagflationary?
You write a little bit about this Treasury market and sort of the balance of demand, and especially as we get new issuances throughout this year. Deficits were supposed to be this thing that were really concerning for the market. And I feel like to end the year, you saw a little bit of that run up in yields heading into the election, and it kind of faded. I mean, how concerned are you about the viability of auctions for the deficit, for the demand and the supply to still be absorbed by this market?
We still have, there might be compositional changes, and there have been over the years compositional changes in terms of the marginal buyer for the treasuries, but we still have very, very healthy demand, obviously, for U.S. treasuries. So our view fundamentally is that demand for treasuries is going to be driven by the business cycle.
You actually doubt one of the doubts that you raise, or one of the flags that you raise, is about the regulatory reforms. And this is the Besant reforms, the threes. 3% deficit, 3% growth, and 3% growth in energy, oil and gas. Put it together whatever way you want. We need to understand. But you don't think that regulatory reforms will generate enough demand for treasuries and for duration to neutralize the looming supply. So you have your doubts around this deregulation story.
Well, deregulation matters. It also matters for banks, for example, right? So there are specific sectors like energy and banks for which deregulation may matter more than for others.
Right.
But the Treasury is such a huge liquid market that really fundamentally what we believe is that if the business cycle does well, then demand will win and go more into risk assets. And if the business cycle slows, then there's no way around Treasury demand.
Well, there a lot of what regulations we have seen have meant that banks are trading treasuries less, that some of the demand and the way that things have been reconfigured is because of that. Then you have central banks abroad who are buying less treasuries and buying more gold. Or we just need to get used to a new normal where it's price-sensitive buyers that are really active in this treasury market?
Yes, and we have had price-sensitive buyers become more active in the treasury market, but as their participation grows, they also become more stable investors in the market.
Do you think we get moments of indigestion in this bond market rather than Liz Truss-like incidents?
Tough question. Tough question. Could go either way, I would say.
I think there's going to be volatility. I think the bottom line is probably there will be moments of sort of unexpected volatility in global bond markets, not just the US. Sonia, thank you so much for being with us. That's Sonia Meskin of UBS, our guest this morning, setting the agenda on the markets. Coming up, port talks, port employers and dock workers come back to the negotiating table. More on the story next on Bloomberg. Hey, it's Bloomberg Brief. I'm Menace Craney, back alongside Danny Berger for 2025. Story for you now. Bloomberg sources say that talks are set to restart between dock workers and port employers in the US next week. This comes as a potential of another mass walkout looms over half of America's cargo. For more, let's get to Brendan Murray, who leads our coverage on global trade. Brendan, good to have you with us. I mean, this takes us back to we thought we had a deal between the International Longshores Association and the United States Maritime Alliance, which was a 62% pay rise, but it looks as if the sticking issue is automation.
Yeah, exactly. They left that issue on the table back in November when they agreed to talks. Those talks lasted only a couple of days, and we've been in this 6 to 7 week stalemate until recently, until the past day or two, when we've heard that they're going to restart those talks starting next Tuesday. So they'll have about 7 or 8 days to iron out those issues before the January 15th deadline. After that, if they don't extend the negotiations, we could see the dock workers walk off the job.
And if that happens, 5 days later, it's a new administration. Trump takes the oath of office. And we had a moment, Brendan, where Trump has said that he, one, supported the dock workers and the union, but two, also supported autonomy, and that it's the way that the world was moving. Where will Trump stand? What do negotiations look like when you have a labor secretary that is now under the Trump administration?
Yeah, there's real tension here between what the union wants, and that's preservation of their jobs, and what the incoming president wants, and that's an economy that's more efficient, better operated, and those kinds of things. That's the argument that the port operators are saying is we need semi-automated equipment to make sure that the increasing amount of goods that move in and out of the country do so efficiently, and in the meantime, the dock workers are saying, no, that's a threat to our livelihood. So you have a real, sort of tug of war here between, the old way of doing things at ports and the future of how to move cargo at ports.
Well, I think just before Christmas, he said, this is President-elect. I've studied automation. I know everything there is to know about it. And the amount of money saved is nowhere near the distress, the hurt and the harm that it causes for the American workers. Brendan, I mean, there's essentially what Trump said before Christmas. So let's see where he comes in on this over the next couple of weeks. Brendan, we've heard from AP Muller-Mars. They've pushed people to move and shift their shipments across the east coast of the United States of America. Is that getting ahead of the issue? What does that do to the flow of trade into and out of the eastern seaboard?
Well, what we saw Maersk say in the past day or two was urging customers to get their containers out of ports, whether those are full or empty. You don't want them sitting there, for weeks on end if a strike happens, and it drags on for longer than people expect. At the moment, the expectations are that this, even if it is a strike, will be relatively short in duration. The economic damage will compound relatively quickly, and so both sides will have an incentive to reach a deal.
Brendan, we really appreciate the update. That is Bloomberg's Brendan Murray. Now, futures kicking off the year with a rebound after a 4-day decline. We are keeping our eye on a variety of stocks in 2025. Bloomberg Intelligence has compiled the list of 50 companies to watch this year. Tim Craighead, Director of Equity Research at Bloomberg Intelligence, joins us now. Tim, give us a little taste. What is company number one that you're looking out for?
Oh, that's impossible to say one company, Danny.
It's like picking your favorite child.
Give you some context. Exactly. Give you some context. I mean, this is a list of 50 companies that fall out of our broader list of focus ideas. You can find it on the terminal, BI Focus. But these are high conviction, fundamental calls that we think are different from where the market lives. And there's catalyst ahead in 2025 to bring focus into our view on these 50. And I think you could maybe answer your question. There's key buckets that I think fall through the list. Think AI, think China stimulus, think innovation and new products. So I think some of those key companies fall into those topics and themes.
Tim, good to see you this morning. The great debate is on AI and whether the Mag 7, the valuations, the earnings, will the earnings live up to the valuations and vice versa? Does the AI, and we've heard this from several houses, does the AI theme broaden beyond the US shores in size and significance?
So I think you can think about broadening in a couple of ways. Number one, the names that we have that are AI-oriented on this list are more enabling technologies, where last year we had some of the LLMs and things like that. So think about Micron technology because of high bandwidth memory chips, or KLA, which makes test and measurement tools that are quite critical, or here in Europe, thinking about broadening out geographically, VAT group that makes valves. And you think, what? But these valves are quite critical to create vacuums, which are critical in semiconductor manufacturing. So I think you can see it broadening out to enabling technologies and then applications of AI as opposed to just LLMs and NVIDIA.
Tim, how much of this could just get upset with any new policies coming in from the Trump administration, be it corporate tax reductions, but with some caveats to that, or be it tariffs? How much could this completely throw everything into disarray for what we're looking at for 2025?
It's a great question, Danny. I guess from our perspective, there aren't Trump plays per se here. And, our economists are thinking the tariffs are more a 2026 issue. It's a negotiating tact this year. But what can come quickly are things like regulatory changes and taxes, and those are both positives. And from that perspective, it plays into more of a cyclical recovery story. We still expect lower interest rates, and from that vantage point, you can see a host of companies that are oriented in that way. Adecco is employment-oriented, Airbus with traffic and improving supply chains. Rémy Cointreau is a consumer product company, a spirit maker. Those are some of the European plays, but then you've got companies like Norfolk Southern and Emerson and others that are on the list that are just good cyclical plays with a president that's in place that we think will lower taxes and will deregulate in various ways.
Tim, let's see what those first 100 days come through with in terms of edicts, orders and policy. Tim Craighead of Bloomberg Intelligence, setting the agenda, 50 top companies for you to keep an eye on. You can pick it up on your Bloomberg terminal. BI Focus Go is the destination. Let's pivot to China there. Tim was mentioning some of the potential risks in 2025. Stocks there have posted their worst start to the year in nearly a decade. Let's get to Bloomberg Markets reporter Justina Lee. Justina, good morning, good afternoon, good to see you this morning. We're kicking off with a pretty bearish start, the worst since 2016. Now, in part, this is to do with the manufacturing data. Let's kick it off there. Caixin, along with deflation, it's the key word that we're kicking off 2025 with.
Yeah, I mean, the Chinese economy got some pretty bad news, at the start of this year already. What's happened is that, the Caixin PMI, it's kind of fell again, and it's still within the expansion territory, but it was lower than what a lot of economists expected, and it was also lower than the November reading. And I think that's just generally adding to the gloomy atmosphere. A lot of traders and investors are already worried about the prospects of, obviously, U.S. tariffs on Chinese goods. And these numbers kind of just underscore how tough the environment is already.
Well, we just came off the back of the Central Economic Work Conference in December, where more spending, more public borrowing was promised, and it was something that had excited investors, but maybe not enough to filter through to equity market sentiment. What now, Justina? When do we see any potential follow-through, any more announcements that you could get some real juice out of?
Yeah, Chinese policymakers have been pretty clear that this year they want to step up fiscal spending. They want to shift the focus to consumption to kind of insulate the economy a little bit from kind of those U.S. tariffs. But I think, what people are watching right now is when is the next monetary policy move? And we've already seen kind of a big liquidity injection recently. So maybe there wouldn't be like a headline, rate cut coming that soon. And I think, for the Chinese government, it's a bit of a balancing act right now, because with the dollar strength, they're also worried about kind of the weakness of the Chinese currency. And we're also seeing that today because they strengthened the fixing to try to stabilize the currency kind of despite the trends in the currency market. So I think where the yuan is going is another thing to watch.
Okay, Justina, appreciate it. Bloomberg's Justina Lee there. Coming up, we're going to set you up for your trading day. Some economic data on deck for January 2nd, your first trading day of the year. Stay with us. This is your Bloomberg Brief. Welcome back. Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's set you up for your trading day on this Thursday. The new year is going to kick off with jobless claims numbers. Those come out at 8:30 a.m. Eastern. Then it will be followed by U.S. manufacturing PMIs, 9:45 a.m. And then, Manish, we're going to get Tesla releasing its fourth quarter delivery data.
Yep, and that fourth quarter, is it going to come in over that 500,000 mark? That's going to be the critically important thing about delivering on Elon Musk's promise for growth. The stock is up 1.2% this morning. You've had a nice turnaround on Bitcoin. That plays, of course, into MicroStrategy. Crypto-linked stocks, they're all rallying this morning as we see Bitcoin up for the third day in a row. U.S. Steel, we've talked about this morning, up 0.6%, jumping the most in a year. In the previous session, again, will Nippon's Hail Mary deal, as our correspondent called it, make it through and over the line with Joe Biden? What are the caveats? What might he do with that final offer that's been slipped across the table? Danny.
Manis, a quick check on your euro this morning. It is weakening versus the dollar by about 1/3%. The euro is now at its weakest level since November of 2022. This is an enduring theme for 2024 and heading into this year, where policy looks not completely diverged, but a Fed that maybe looks something like on pause, and a Europe that's forced to cut, especially with Trump tariffs.
I mean, just going back to 2016, just looking at the data, that trading into 2017 came under immense pressure, but the dollar was so strong last year, up 8% overall, best year since 2015.
Yeah, and look, the bar is very low for Europe, so maybe we could get a surprise. Well, that's it for your brief. Surveillance will take it from here.